A company can be worth $47 billion and be worth nothing at all. Those things can be both the true at exactly the same time. WeWork was valued at $47 billion in 2019. 80 months later, it was on the edge of the bankruptcy. Nothing blown up. No fraud was open. No product failed. The world just looked more carefully. And that is the fault of no one explained to you. You are watched this story from the outside. You saw the headlines, the billions, the collapse, the Netflix documentary, and somewhere in the back of your mind, you filed it under the billionaire cause. You told yourself it was too extreme to be relevant to your life. But here's what you actually felt when you watched it, a quite unsettling question. If $47 billion can be a fictional, what else is? You look at the number on your saving account. You look at the value of your house, your pension, your investments, and you wonder just for a second whether any of it is real. That feeling is not a paranoia, it's an intelligence. You sensed something true without having a framework to name it. The Weaver story is not about the one reckless founder. It's about how value itself gets created, inflated, and destroyed. And once you understand the mechanism, that quiet question has answer, not a scary one, a clarifying one. The standard story about Weaver is that the Adam Neumann was a fraud. That version is not a wrong. It stops too early. The conventional explanation is that one, the charismatic man convinced investors to suspend belief. And yes, that happened. It's documentation, it's real. But it does not explain how the world's most sophisticated investors wrote those checks. SoftBank was not run by amateurs. Goldman Sachs man as not asleep. These were the rooms full of the people who understand the money better than the almost anyone. They were not fooled by the charm alone. They were using the valuation method made $47 billion look rational. That method has a name, it has a rules. It's still being used today. The gap is not in their intelligence, it's a framework that was built to reward a certain kind of the story, and understanding that the framework changes how you see every big valuation you all even encounter. When the investors value a traditional company, they look at the profit. They look at what the company earns now and that they project it all earn in the future. But in the early 2000s, a new kind of the company started to appear. These companies lost money every year deliberately. They were not failing. They were not spending uh, to grow as fast as possible. Amazon did it. Uber did it. Netflix did it. And it worked. These companies eventually become genuinely enormous. So investors created a new way to value companies. Instead of looking profit, they look at the growth rate and the market size. Here the simple version how that works. Imagine you are opening a coffee shop. You spend three times what you spend in year one, but you are opening in an airport and 1 million people walk past every day. An investor might look past this year loss and price the shop for what it could be worth. That logic extended to the scale of the billions is called growth investing. And it is not a rational. It correctly valued Amazon for the 2 decades. The problem comes when the growth story is borrowed. WeWork said, we are not a real estate company, we are the tech company. Tech companies grow exponentially. Tech companies deserve tech company valuations. And this is exactly where the most people understanding the stops. Here's the psychological layer most financial explanation completely skip. There is a cognitive cause called narrative transportation. This describes what happens to your critical thinking when you are inside compelling story. When a story is vivid enough, specific enough, and emotionally engaging through your scrutiny drops. This has been documented across decades of psychology research. Your brain shifts from the evaluation mode to experiencer mode. You stop asking, is it true? You start asking, what happens next? Adam Neumann was exceptional as a creating narrative transportation. He did not describe a shade of his business. He talked about the elevating the business world consciousness. He talked about the changing how humanity works, lives, and connects. That is not a pitching. That's the storytelling at the clinical level. And here's what makes his psychological significant. The investors who heard that the story were not uninformed people in a public meeting. They were the professionals in a private room with a legal obligations to do the diligence. And still, the more impressive the version, the less rigorously they question the new numbers. You have felt a version of this yourself. Think about any large purchase you made that you later regretted. There was probably a moment where you stopped asking questions and started imagining ownership. You stopped thinking about the price, you started thinking about how would it feel. That is a narration transportation on a personal scale. WeWork did it on a $47 billion scale. And when you put the actual numbers to these, the gap becomes very hard to ignore. In the next 12 months before WeWork attempted IPO in 2019, the company had a revenue of $1.8 billion. That sounds significant, but in the same period, it spent $3.5 billion. For every dollar it earned, it spent nearly two tickets to be worth $47 billion. At that loss rate, WeWork would need to grow fast enough to eventually dominate its market. Its stated market was the global office space. They valued it at the $3 trillion. Even 1% share of the $3 trillion would justify billions in valuation. But here's what the IPO prospectus revealed when it was published. Weaver was signing long-term leases often 15 years. It was renting short-term often month to month. In a downturn, companies would cancel short leases immediately. Weaver would still go rent on long leases for the another decade. The business models was built on the assumption of the permanent economic stability. The moment analysts read those details, $47 billion started shrinking. Not because the story changed, because the numbers were finally visible. Within the weeks of the publishing prospectus, the valuation dropped below $20 billion, then below $10 billion. SoftBank, which has invested around $10 billion, was forced to take control. By 2023, we were filed for the bankruptcy with the liabilities of over $18 billion. The businesses that had been worth $47 billion had created nothing that outlasted it. Not infrastructure, not intellectual property, not a proprietary system. It had signed teasers at a loss in a building it doesn't own. The $47 billion was never the company's value, it was the price of the story. Here is the single shift that changes how you see the valuation. Price and the value are not the same thing, and they stay different for a very long time. This is not a cynical idea, it's actually a reassuring once it settles. Because it means there are always two questions to ask about any asset, not one. The first question is, what is the market willing to pay for this right now? The second question is, what would this produce if you owned it forever? WeWork investors only asked the first question. They asked what others would be willing to pay next year. They were not buying a business, they were buying a position in a story. And the stories have a no floor. When you ask the second question, what would this actually produce? You need numbers, you need cash flow, you need a margin, you need something that exists outside the narrative. That second question won't protect you from the every bad investment, but it will protect you from the paying for a story. The next time sometimes tell you the company is changing the world. That's not a reason to ignore the second question. It's a reason to ask it more carefully. The next time you see a headline about a company with a large valuation and no profit, here's what changes. You already know the valuation reflects what investors are willing to pay for the story. Now you ask, what would need to produce to justify this price? You don't need to complex max. You don't just need a direction. Is the gap between the price and the reality closing or widening? Amazon gap closed. It became profitable, dominant, and real. WeWork gap was growing when the IPO arrived. That's the distinction worth making. The second thing that changes is how you think about hype around assets you personally own. If you own stocks, property, or any investment, watch for the moment you reason for the owning it becomes everyone else want it. That's a narrative transportation operating on you. You don't need to sell at that point. You don't need to reconnect with the second question. What does this actually produce? How does I feel about it if the price did not change for 5 years? If you can't answer that honestly, you are outside the story. And the thing is the third is the simple. Be a reader of the prospectus. Not every document, just one for anything you are seriously considering. When the numbers are published in detail, the story has survived contact with reality. Weavers did not. You don't need to distract every large numbers you see. More valuations reflect something real, imperfectly, incompletely, but genuinely. The Weaver story is not a reason for the cynicism. It's a reason for the literacy. Financial literacy is not about the knowing more formulas. It's about the knowing which questions to ask before you trust a number. And the most important question in investing in business, in personal finance, is always the same. What is the actually worth apart from the what someone is willing to pay for it? If you can't separate those two things clearly, you see the world differently. You see clearly when the gap is closing and when it's growing, and that the clarity is more useful than any specific tip or a trend. If this kind of thinking is what you are looking for, the kind makes the familiar things makes more sense. This channel has more on it. Subscribe and we'll keep on going. Thank you.